Mr. Lu, you always talk about a crash is coming, crash is coming. So when is the crash coming? Certainly, with so many crashes that happened in the past, we can certainly have a smart guess when the crash is coming, right? So today, Mr. Lu will attempt to pull out all the past crashes and see whether we can detect any signal from there. That will be an incredible, insight if we can guess when the crash is coming, right? So let's watch on, shall we? So these are my usual disclaimer. This is what I'm trying to see for myself, general education, not to tell you to buy or sell. I think most seasoned investor, most expert investor will agree with me that a market crash will eventually come. Market crashes are part and parcel of the stock market journey, just that we don't know when. So this is what I think is very interesting and scientific, but what people say, 废话, Mr. Lu, this one I also know. However, if we can take a look at hindsight, right, and see whether we can detect any signals from there, maybe we can then predict the current one, when is it coming in, so that we know when to sell and make money from it. Not only do we not know when the stock market will crash, we also don't know how strong the current bull run will continue. We don't know how long it will last. We don't know how high it will go. But I think it's good to use history to take a look at all the bull runs in the past, and maybe there'll be a hint that we can see to when the extent of this current bull run will last. So let's all go back to history, shall we? The history that we're going to go as far as 1987, when I was still a small little boy. The prelude to 1987 was an incredible bull run. So this is where Paul Volcker actually dealt a decisive blow to the inflation by spiking the interest rate very, very high. And we actually made a lot of money from it. And if you recall, I talked a lot about this called the Volcker's Bear. And we are able to make a lot of money from the current stock market because I mirror it to that event. And the stock market then went up after the inflation went down. And it went up and up and up and up and down and up and down and up and down and up by 3.3 times over 5 years. If the same thing were to happen, 3.3 times 5 years, and I think somewhere at the bottom of the stock market was about 3,500 points or something like that during the 2022 crash. And it would go up by 3.3 times. We are looking at the S&P 500 hitting 10 over 1,000 points in the next 5 years, if this were to happen again. But guess what, right? It all happens in a sudden crash, and the crash was so bad that in one day it went down by 20%. So a lot of people will be, just going crazy while buying, and guess what? That 20% will just wipe out a lot of people's savings and lives. And I don't know, people actually kill themselves in the process. In this case, the recovery wasn't that bad. It actually took about 2 to 3 years to recover, and things went up and down again. But the first number we take a note is 3.3 times for S&P 500 over 5 years. That was the whole bull run before the 1987 black market. So what fueled the bull market? Well, at that juncture, inflation was on the decline and were aggressive interest rate cut, as we have seen. So there was a signal that a bull run is coming, and we have copied the entire book, the 10-year series, and use it for 2022 onwards, and that's how we make money this time. But what caused the crash? Well, the truth is, in 1987, nobody really know what caused the crash. One of the factors that caused the entire market crash was there was a program-driven trading model. So there were a lot of people using programs, and suddenly that triggered a massive crash, and then there was a massive investor panic. The computer just went massively in selling stocks, and as a result, this led on more and more to an incredible crash. Well, one of the big reasons is the whole market has went up phenomenally already. So the next bull run that we like to analyze is the 1997 all the way to 2001 dot-com bubble. So somewhere around 1997, all the dot-coms start emerging, and they are really promising the heaven and, and the stars and the moon. And as a result, the whole stock market went up in an incredible mania. And it went up by 2.4 times over 5 years. And in a spectacular 2001 dot-com bubble burst, it crashed massively by 50%. The crash went down for 2.5 years. That means it kept crashing, It didn't just one short crash. It crashed for a long time. And I would imagine that during that time, everybody will be thinking that I think this is just one of those downswing. Can you see this downswing here? That will recover. But it didn't, right? You don't exactly know when the downswing will come, and it crashed all the way down to a massive 50%, and it lasted for a very long time, very, very long time. So if you take this mark here, 2001 dot-com bubble burst, it recovered only about the same point at 2007. Imagine you bought around the peak here. It just managed to recover and then you went down again, right? So this is a terrible, terrible, terrible crash. This one is one of the massive one. And by the way, I didn't pull out the NASDAQ one. The NASDAQ went down for 16 years before they recover. So I'm now 52. And it simply means that, if the crash would happen and lasted for same period of time for NASDAQ, I have to wait for until I'm 68 years old. That's a massive long wait, right? So this is the nature of it. So what fueled the bull run? Some of y'all may remember, it was a period of low interest rate, easy access to capital. And many tech companies just have this crazy, incredible bull run because this is a new matrix and everybody is saying that, these kind of new businesses, you don't need to look at profitability. You have to use eyeballs. You have to use new mode of gauging success. So those companies were able to IPO with no track record of success, and many of them were all making losses. Some of them don't even have a dollar of revenue. So in that period, the bull run just went up ferociously. And what caused the crash? What caused the crash is when the tech companies started running out of venture capital money, and they started to realize that they're burning cash too fast, and the VC money cannot sustain them to go with this, and eventually started to underperform, and then that's it. Okay, they started to have bankruptcy, and then suddenly the whole dot-com bubble just burst. So let's take a look at another one. This is the 2008 global financial crisis. Here we recovered from the dot-com bubble burst, and the whole bull run went up for 5 years by 1.9 times over 5 years. And then the global financial crisis happened, okay? The whole market just crashed by a massive 52% in 1.5 years, right? So it was a very painful crash, and everybody who is around my age will remember how painful the crash was. So what caused the whole thing to rise? Well, it's again, low interest rates, very liberal lending. They have a lot of ninja loans, right? No income, no jobs. You can still borrow money like crazy. And there was an incredible housing bubble, caused the whole market to go up. And then there were a lot of derivatives being developed to grow and exploded the whole market. It was just messy, but yet the whole bull run went up ferociously. But what caused the crash? Interest rate caused the crash. As the interest rate rise, a lot of people start to default on their mortgages, and the subprime lenders went bankrupt, causing banks to collapse. Bear Stearns, Lehman Brothers, and at one point in time, almost AIG and Citibank. And the crash was massive. And guess what? It was a terrible time, and there was a massive panic, right? So I think there's a lot of lesson to learn here as well. Financial crises are quite scary. Is this predictable? Well, some people did. If you watch the show, The Big Short, some people actually managed to predict this market and made a hell of money. I don't know whether you are going to be that good, but there's some people actually did it. The next bull run that happened was around after the trade war with between China and US. The whole market just went up by 1.4 times over a 1 year period. This was a Donald Trump trade war period, and then it just went up by about 1.4 times, right? And the pandemic broke out, and in that 1 month, it went down massively by 34%. And as fast as it went down, as fast as it went up again, right? So I managed to catch it somewhere around here. I never seen such a bull run before, and the signals was clear, and I went in somewhere around June period, and it just went all the way up, and the rest was history. So what caused the bull run then was the end of the trade war, and there was a lot of interest rate cuts that were done by the Fed to make sure that the whole economy don't sink down, and that caused the whole thing to go up. And what caused the crash? Of course, it was a COVID pandemic, and the crash was quite obvious. All of us went through that, so I don't need to further elaborate on that. But the massive crash that went up and the subsequent recovery was unprecedented as well. We actually can take a chapter from there, right? So all said and done, what can we learn from all this past bull run and crashes? Because if we can tell certain signals, right? Whether is it the extent, the length of the period, economic signals around it, and so on, then it's very clear that we can wait until somewhere before the market crash. We sell, okay, let it crash, and then we buy again. Now, Mr. Lu has some experience in catching the bottom, but so far I've been trying to see whether I can perfect the science of catching the top. So what have we learned from all these past bull runs at the peak? What are the signals? Well, the truth is, no matter how I try to look at the signals, I've been looking at it, and the truth is, we cannot predict anything. We cannot predict anything. This is something that my son said, which I thought was very smart. He says, crashes are easily predictable on hindsight, meaning that if you look at what has happened after the event has happened, then you say, oh, it's very obvious what 2007 financial crisis, we know that there was a lot of subprime loan, people were being reckless and things like that. 1987, before Black Monday happened, the whole market was in a mania. So was dot-com bubble, right? It just blew out of proportion. Easier said than done. Crashes are easily predictable on hindsight, but impossible to predict on foresight. You cannot see it easily in the future. And of course, then after the whole event is over, you look back at it, oh yeah, no. So it is really very difficult. I think there was a famous investor called Howard Marks. He actually said that, since I cannot predict the future, but I can actually predict the current situation. And you look at the current situation or wherever it is, and then he make a prediction out of it, if it's too dangerous, conservative, or whatever, right? I tend to adopt that philosophy as well. I look at the current situation, I say that, is it high risk, low risk? And I make an assessment of it. I cannot tell you what you should do, to be frank, okay? I don't know how to predict when the crash is coming. And it's not that I did not attempt. A lot of study, a lot of effort, a lot of analysis has went into it. Maybe I'm not smart enough, okay? We have used macroeconomic signals, we've used price signals, we've used qualitative and quantitative analysis of all forms. I did not provide all this detail, and yet it is really very difficult. Bull runs can last irrationally for very long and can crash massively within a very short time and can last also very, very long. So this is where I have always encouraged myself. I will only buy massively when there is a massive crash and stay out the whole market and just let it run. So that's how I can consistently make money. And I don't think I'm the only one to do that, right? So there's a lot of very strong investors like Warren Buffett, Howard Marks, and all these. They actually went after the market when there's blood in the streets. So they are greedy when other people are fearful. And that's the same mentality I have. Some of you said, wow, the bull run is so wonderful right now. I'm going to start dollar cost averaging now. I don't see Warren Buffett doing that. I also certainly don't see a lot of good investors doing it. Maybe there's some, not the ones I like to follow. And certainly, I'm not going to be one that dare to do that as well. At this juncture, I've talked a lot about rebalancing. I've already started on the process of rebalancing into a healthy portfolio of a certain percent by stocks, a certain percent of bonds, certain percent of cash, and so on. And that's very healthy, and this is very financial investment 101, right? Everyone talk about this even in the textbook. So I think this is quite healthy. So let me hear your comments. Maybe you guys can see certain signals I cannot see. But if you guys cannot, happy to listen to some of these comments from you. And I'll see you in a day or two. Thank you and bye-bye.